Being underwater or upside down on your mortgage is one of the most challenging situations to be in as a homeowner, and more people are finding themselves in that position right now in 2025. In fact, underwater mortgages just hit their worst level since 2007, and more homeowners now owe more on their mortgages than what their home is worth. And unfortunately, those numbers are only getting worse. But I'm going to show you what you can do if you find yourself being upside down on your mortgage right now. Now, over the past 10 years, most people have gotten used to the fact that home prices have only known one way, and that's up. So most homeowners believe that it would be impossible for them to own more than what their home is worth. Now, unlike owning a car, which obviously depreciates over time, especially in the first 2 years of ownership, real estate tends to increase in value, and well, historically speaking, real estate has appreciated at an average of 5.1% a year over the past 45 years. But according to Zillow, home values are projected to fall by 1.4% this year, largely due to the rising housing inventory. And in the first quarter of 2025, seriously underwater mortgages rose to 2.8% nationwide. Now, by definition, a serious underwater home is one in which you owe at least 25% more than what your home is worth. And according to CoreLogic, underwater homes jumped by 9.3% last quarter, now totaling to about 1.1 million homes, or roughly 2% of all mortgages outstanding in the United States. And even though home equity has doubled in the last 7 years, the average homeowner lost $4,200 worth of equity since 2024, while negative equity homes increased by 17% to affect roughly 1.2 million households. Now, at the same time, home prices are increasing, but the rate of increase is slowing down fast. Because according to the Case-Shiller Index, price growth increased by just 2.7% year over year in April, and that's really the weakest pace in almost 2 years. Now, this means that homeowners are at risk of losing even more equity as the market continues to slow down. And places that boomed during the pandemic are getting hit the hardest. For instance, Cape Coral, Florida nearly has 8% of their mortgages seriously underwater. And meanwhile, over 4% of homeowners in Austin, Texas, and San Antonio, Texas are seriously upside down as well. And in places like Louisiana, Kentucky, and Mississippi, 6 to 10% of all homes are in serious negative equity, with some Louisiana parishes above 14%. Now, unfortunately, those most affected are not really investors or institutional landlords who are making money off of real estate. It's those first-time home buyers or buyers who got into the housing market a little bit too late after the pandemic, and often they were using a low down payment program like FHA loans or down payment assistance or VA loans, which don't require a down payment. And those people who get into these loans are more at risk when home values drop. So in some areas, when home prices started cooling down at the end of 2023, any little equity that they have is pretty much gone. Like for instance, this homeowner in Phoenix, Arizona, who closed on this home at the end of 2022 for $465,000. And 2 years later, they're now selling at a loss by listing their home for $460,000. Now that only looks like a $5,000 loss, but after realtor fees and closing costs, this person is not looking at a $5,000 loss, but actually losing anywhere between $30,000 to $40,000 when it's all said and done. And if you're underwater and you want to sell, this means that you now have to bring cash to the table, which for many people, it's almost impossible. Not only to make up the difference on how much you owe to the mortgage company, but also for, well, real estate fees and other closing costs. And most sellers are looking at paying about 6% in realtor commissions alone. So if you're selling a $500,000 home, that's $35,000 in realtor commissions alone. Add another $5,000 to $7,000 for closing costs, and you're looking at $40,000 easily to sell a property. And depending on the type of loan that you have, refinancing isn't really possible until you have enough equity or you regain the equity that you lost, which means that a lot of people can find themselves stuck for a very long time by not being able to sell or by taking advantage of refinancing to lower their payments. Now, with all this being said, we're not really seeing, and likely we're not going to see, a wave of foreclosures because, well, lending standards are way stricter than what they were back in 2007, and most households, especially those who bought before the pandemic, also have a pretty good amount of equity right now. In fact, even with these equity declines, US homeowners still hold over $17 trillion in total equity. But if you're not one of the lucky ones with a ton of equity in your home and you're finding yourself upside down on your mortgage, here are some things that you can do. Now, the first one is try to stay calm, because unless you are having to sell because of a life-changing situation like your job is moving you away, or you have a family situation, or you're getting divorced, then just stay put, because history has already shown us that the markets will eventually recover over time. Now, the second thing to look at is at refinancing. Now, most people believe that refinancing is not possible when you owe more on your mortgage, but that's actually not true, because there are certain situations that allow you to refinance into a lower interest rate and lower your mortgage payments regardless of how much you owe versus what your home is worth. Like, for instance, if you have an FHA or an USDA loan, so as long as you are on time on your mortgage, you may be eligible for something called a Streamline refinance. And a Streamline refinance doesn't require an appraisal, income verifications, and in some cases, it doesn't even require credit scores. So the only requirement is for you to be on time and not being behind by more than 1 month in the last 12 months. And the main goal for a Streamline refinance is to allow the homeowner to take advantage of a lower interest rate. So if you bought a home in the past 2.5 years, odds are you have an interest rate above 6%. So if or when interest rates drop, you can take advantage of the lower interest rates at the time to lower your monthly payment. Now, if you're a veteran and you have a VA loan, you too can actually take advantage of a special type of VA refinance called a VA Streamline Refi, or Interest Rate Reduction Loan, or IRRL for short. And this too is also going to allow you to lower your interest rate, lower your payment without the need of an appraisal, and it's a very simple transaction. And again, it doesn't matter how much money you owe on your mortgage and what your property is worth. Another option that I would consider is to make significant improvements to your home by forcing equity into the property by rehabbing it extensively. Now, many people don't know this, but you could get a home improvement loan like an FHA 203K or a conventional home style mortgage to do all of these renovations, even if you're currently upside down. Now, hear me out on this one. If you make certain improvements to your home that can make it be worth more than what you currently owe, then, well, you no longer will be underwater. Now, at that point, once you have done all your renovations, you can decide whether to stay in the house for longer and enjoy exactly what you did, or turn it into a rental, or just go ahead and sell it for a gain. Now, the third option I would do is to consider to either rent out the entire house if it at least breaks even, so that you can move out and now you can have some income coming in for you to pay for the house until you can sell it, or maybe you can rent out a room or a portion of your home to generate some extra income. Because depending where you live and the state that your house is in, you can rent out a room for anywhere between $600 to $1,000 a month, and a basement or an in-law suite for at least $1,200 a month in most places that I know of. And this way you now can have some additional money coming in, so if you're struggling to pay your mortgage, at least this can help you out. Now, the fourth thing that you can do is to stay put and chip away at the balance by adding more money towards your principal. Now, again, unless you need to make a life-changing move, just staying put and paying your mortgage and really just stop listening to all this noise might be the right thing for you. Because I feel like so many people freak out because they're watching the news, they're watching all of these YouTube channels and all of these YouTube videos about the market melting down and crashing, and then they just end up making some stupid, erratic, hasty decision when they don't really have to. Look, after 2008, which was the absolute worst market in history, hundreds of thousands, if not millions of people gave their homes back to the bank when they didn't need to or they had to. They just saw that the market tanked and they try to get out at any cost. But many people who bought in 2006 and in 2007 at the height of the housing bubble, they stayed put for the next few years. They recovered all their lost equity, and those who stayed put even longer saw their home values increase by 3 to 5 times than what they initially paid for. And in that time, the government came out with several programs to bail homeowners out of high or adjustable interest rates by offering programs like the Home Affordable Refinance Program, which was really popular back then, which allowed people to refinance regardless of their loan to value. And also for those people who were severely behind on their mortgages, the Home Affordable Modification Program also allowed those homeowners to modify the terms of their loans to help their payments if they were behind, and so that they didn't lose their home into foreclosure. Now I know this because my parents were in the same position back in 2009. They bought their home for like $170,000 in 2006. And by 2009, the house wasn't even worth $100,000. Homes in the neighborhood were selling for less than 90 grand. And they stayed put, and by 2011, their value was already back to what they had already paid for. And by 2019, their equity had exploded as many people's did over the last few years. Now, if you really have to sell, then try selling your home on your own. This can save you a lot of money, especially in real estate agent fees. Because even if you get to save 3% in realtor commissions, that can be a lot of money considering that the average price of a home nowadays is $400,000. So that's $12,000 in agent commissions that you can save. So consider doing something like a for sale by owner. And for people who go out this way, I highly recommend that you learn how to run ads on Facebook or some social media platform and advertise your home. It's really not that complicated. Now, finally, if you are severely upside down, then explore doing a short sale. This is when the bank agrees to take a loss on the mortgage because you simply cannot afford it anymore. And if you want to be a homeowner again in the future, FHA loans allow you to purchase a home after 3 years of doing a short sale, and some programs known as non-QM loans might allow you to buy another home even with less than 2 years after a short sale, so it's not like you're going to be barred from being a homeowner again in the future. Now, with that being said, I try to stay away from going into foreclosure as much as possible because having a foreclosure will shoot your credit worse than a bankruptcy ever could, and it could be a lot longer until you can buy a home all over again. All right, guys, that's all I got for you today, and hopefully these tips can help you save some money. Thanks so much for watching, and I will see you guys on the next video very soon. Take care.